Because fixed income, it's really trying to target objectives for clients and really how does it fit with them. So really that is where I think the big opportunity for clients are in fixed income at this point. You know, and actually the easiest way to kind of get clients to think about how to take that next step is to, what is your outcome? What are you trying to achieve? Doesn't matter if interest rates are high or low, you know, this fund's going to try to outperform cash.
We really have to manage investors' expectations. So when rates for our yield will come off as well. So it's still a better home for your cash than, say, putting it in deposit and other type of investment options. But some of them even go to the extreme that within that fixed income bucket, they only invest in short duration bond because they have a lot more other risky investments going on and they just want to have this as more of an anchor within the portfolio.
What do you mean by marginal risk? Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut, and today I'm joined with possibly one of my favorite co-hosts. Yeah, in the running. There are a few of them, Anthony, Don, everybody wants to be my favorite co-host. Yeah, so for everybody that somehow still don't know you, would you like to introduce yourself?
My name is Dave. I'm a minimalist financial coach, and I'm also the blogger behind Minimalist in the City.
Okay.
So which talks everything about financial independence, personal finance, and of course, minimalism.
Still a lot of minimalism or lesser? Minimalism is the last thing.
Nowadays, it's less of minimalism. I think it's more about personal interest, hobby.
Yeah. Because nowadays got bigger problems to fry, right? Yeah, so what have you been busy looking out for these days?
Oh, wow. You!
It's all over the forum. Everybody wants more yield. We've been doing some of the previous investment episodes. Everybody at the bottom say, hey, where's the yield? Where's the yield? Where's the yield? Even the CPF episode, we did an episode, and then I think Dr. Chong, right? He was like, oh yeah, now I got a lot of money in my OA. What do I do with this thing since the SA closed?
Ever since the yield was very high, we were like, oh, not much business. And then recently the phone kept on ringing, and then was like, okay, a lot of things happening around. Yeah.
So people are very interested to find yield in the market because I think everything is coming down. Interest rates coming down, TB is coming down, SSB is coming down. So at this juncture, I am very excited to be in studio with our friends from Aberdeen. Right? Of course, when I first saw the email, I think my guys were saying, Aberdeen, isn't this a port city in Scotland? What have they got to do with us? So I'll leave our guests from Aberdeen Investments to share with us a little bit more, right? Like, what do you guys do and all that good stuff?
Thank you for having us. And hi to everyone who's listening into the podcast. I'm Natalie Tan. I'm the head of Wholesale for Southeast Asia at Aberdeen Investments. So what exactly do we do within the wholesale function? So simply put, we are responsible for promoting Aberdeen's investment capabilities and product offering to a wide range of distribution partners, which include banks, insurance clients, and also financial advisory firms, digital platforms, etc. So personally, I have always been in the asset management industry. Been with Aberdeen for 10 years already.
Wow.
And it's been a great decade so far.
Hi to everyone who's watching the podcast today. My name is Amit. I am a fixed income investment specialist. And for people who don't know what that is, I work with the investment teams, but also very closely with Natalie and her teams to sort of support bringing exciting offerings to the market for our clients. And as you'll know from the accent, it wouldn't be an Aberdeen Investments podcast without having someone from Scotland on here. Face doesn't look like Scotland, voice sounds like Scotland. I moved to Singapore about 3.5 years ago, and to be honest with you, one thing that reminds me of home is the rain. Scotland rains a lot, but so does Singapore, so it makes me feel at home. So this is my home.
How did you even end up here?
I mean,
all the way from Scotland.
Exactly. People didn't think I'd leave Scotland. I was there for so long. I've been in the company for nearly 20 years. The face doesn't look, I know, it's a moisturiser. But no, what it was, there was an opportunity internally to move from Edinburgh to Singapore, and from a professional perspective, great opportunity to come into a growing market, really exciting part of the world. And Singapore, a great place personally to move to and experience, life here. So both from a professional, personal perspective, I had the opportunity to move, and I've not regretted it.
Okay, maybe share with us a little bit more, right? For our audience that are not yet, familiar with Aberdeen Investments, can you share with us like a little bit about your heritage? How do you come about doing this and all that?
Aberdeen Investment has been been in Asia for over 30 years.
Yeah, I know that shop house at China Square. I always walk past. It's like, what is this?
Very iconic
Very
office at one
iconic.
point.
Yes.
We set up our first office in Singapore back in 1992. Wow. And we've been here ever since. When we first started, there were only like 20 employees in the Singapore office. And I bet you will never be able to guess like where was our very first office. It's actually not the Capital Square shop house.
No? Okay.
Do you want to make a guess?
Do you have a clue?
It's a very happening spot.
Happening? Clarke Quay.
Close enough.
Close enough.
What key?
It's Boat Quay.
Yeah, it's actually in Boat Quay. Yeah, but of course, fast forward to today, Singapore is our APAC headquarter. We have over 200 employees in the Singapore office, and we are currently based at Marina One. A lot of investors know Aberdeen Investments for experience in investing in Asia and emerging markets. But today, we are also known for a number of our very specialist capability. I think within the fixed income space, we are very strong in public and private credit. And that is something that we will talk about.
Basically touching on the heritage, for fixed income makes over a substantial portion of our book of overall assets. We have about almost $880 billion in fixed income across different parts of the capability space. But our insurance heritage from way back gives us that expertise to be able to manage clients' money from a very prudent perspective. So fixed income is all about being prudent. It's all about looking at the downside. And we have a lot of heritage and expertise in that space.
Great, because I think that fits into exactly what people are looking for, right? They want more yield, but they want safe.
That's right. That's right.
Can you give me a bit more color, like before coming here, and because you're the product guy, right? So like you guys have a big asset under management, right? I think 400 over billion pounds, right? So which part of that do you disturb?
So fixed income, so that's the debt of companies and governments and institutions. That's the part of the market that are the products that I more closely work with and related to. And that can be anything from, money market funds that people are aware of here, or government bond funds. People are familiar with government bonds, all the way to, companies who issue debt, whether those are from developed markets or from emerging markets or Asia, right into even single country funds. So, China, India. So we actually have quite a big variety. More recently, what we've been looking to do is bring some outcome-focused solutions in fixed income to the market, because fixed income is quite a technical asset class, so I'll hopefully not get too technical on this podcast, but essentially it's really trying to target objectives for clients and really how does it fit with them. So really that is where I think the big opportunity for clients are in fixed income at this point.
What is an outcome-focused?
Imagine a client's in cash. They've been benefiting from very high interest rates in the last few years. Now those have come down. So what's the next step? And actually the easiest way to kind of get clients to think about how to take that next step is to, what is your outcome? What are you trying to achieve? If it's a client who needs more income because they need to pay their bills or they just need it for retirement, then actually that is an outcome. So for us to help clients see an outcome that they can relate to makes it easier for that decision.
And I think he rightfully pointed out the backdrop, because it's all over the internet, right? So, the T-bills are down, the SSBs are down, People are talking about like, where can I put my money? What do I do? Blah, 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 right?
How do I get a higher yield from somewhere?
Yeah, exactly. Yeah. And there are a myriad of tools out there, but there are certain principles that I think we want to highlight today. And then also can talk a little bit about one of your funds, right? So maybe for a start, can you kind of share with us that concept, right? So, okay, now everything is down, right? So what do I do about it? How can I kind of engineer more yield within my portfolio?
Maybe I can start off by just, talking about the differences between the different options that we have. So you mentioned about Singapore savings bonds, money market fund, and the solution that we'll talk about is actually called short-dated enhanced income. We like to call it SDEI, less of a mouthful. And I think a lot of the audience will know Singapore savings bond, very safe instrument. When you invest in them, basically you're lending to the government. So it's pretty much much capital guaranteed. One thing to note is that it's actually not traded in the open market, which is a good thing. I mean, you don't get like the kind of price volatility. And when you buy into money market funds, you're basically investing in very short dated, typically less than a year, very low risk debt instrument. So overall, money market funds are deemed as a very safe investments. So the fund that we're talking about, SDEI, is actually a fund that invests also in short-dated bonds issued by government and corporates around the world. And it's basically aiming to achieve a very enhanced yield while maintaining price stability. So that is actually very key to what the fund is trying to achieve. So from a risk standpoint, I would say that it is still considered low risk. But if you put them side by side, Singapore savings bond, money market, and SDEI, you can see like a marginal risk step up. And to add from a return perspective, if you look at Singapore savings bond now, like you said, right, yields have been really falling.
Yes.
For Singapore savings bond, actually your return upside is being capped. Yeah, because when you buy in, the rates are fixed, and it depends on how long you actually hold the bond for. I just checked before this, right? If you actually hold the bond for 3 years, you're talking about 1.7% kind of a return, which I would say a lot of investors wouldn't be very, very happy with. Money market funds, you probably get like about 10 basis points step up in the current environment. Yeah, so from a return perspective, it is definitely more rewarding.
In terms of like, I'm managing my clients' money. So basically, I kind of like build some emergency cash for them before they actually start investing. So my philosophy is always to kind of like, my own philosophy is to keep like Singapore saving bonds as the benchmark. Then after that, I layer up with like T-bills, those shorter term like T-bills and FD. So I was just wondering like, how do the SDEI fit into such a makeup of the whole portfolio?
That is exactly why we created SDEI, actually, was going back prior to 2022 when interest rates went up very, very quickly. We actually looked ahead and thought, what's going to be the next issue that clients and advisors and portfolio constructors are going to have? And it's actually this huge flow of money that went into money markets, that went into FDs. I think there was a stat out there that at its peak, money market funds hit something like 6 trillion in terms of assets, and just the amount of money. I mean, most of us I became quite a lazy investor. I just put it in the FD, rolled the FD, everybody did the same, right? So now that's become a problem for us now. Whereas before we could relax, no issue. So I think that's where SDEI, where we created it, it was really to be a credible step out of cash option. And exactly to your point, it was trying to create that next step for people. Where do I go? If I don't want to take on too much risk to get more yield or more income, how do I do that? And as Natalie pointed out, there's those kind of principles that we created, which was enhanced yield, price stability, and actually liquidity from both a portfolio perspective and settlement as well, getting your cash quicker as well. Those are 3 characteristics, I think. If you're going to be credible, that's really what you need to offer clients. So that's where I would say SDEI kind of comes in.
Everybody will tell me better returns, but risk managed. Everyone says that. Everyone on the street says that, right? So I want to get a better idea from a construction standpoint, right? Like, what do you mean by marginal risk, right? Like, because you say you put them side by side, marginal risk. Give me that breakdown, right? What does that mean?
Yeah, I think we can go into more specific detail, like, what we're talking about in terms of duration, in terms of volatility, and kind of drawdown management.
Just to share, right? Because from my understanding of this market, it's very simple. You want more yield, you move up the risk curve. Or you move deeper into the duration, right? You buy longer or you buy riskier, right? Essentially, that is the first principle of the fixed income market.
Actually, that is where SDEI can give a good balance between that, because you're right. Traditionally, clients or portfolios would need to go down, the credit spectrum into, riskier bonds or lower rated bonds, or as you say, moving out the maturity scale. But what we saw, I guess, in 2022 was actually short dated bonds started to yield more than longer dated bonds. So again, back then, actually taking that risk to go further out wasn't really needed to get a better return. And again, you saw a lot of, because of the high level of interest rate, very good quality, issuers like Singapore, like, Temasek, all these really high quality issuers are having to issue at higher levels of coupon or interest. So actually you're getting very good yield from high quality. So where does this fund actually get that from? There's probably three aspects to that. And one is absolutely to your point, using high quality or maybe delving into some, very specific ideas that are maybe slightly higher yielding, but there is a cap on that. So there's about 20% cap into what we call high yield. And then from there, you can also be a bit clever. So what you can do is you can invest in there's different types of debt that can be issued by an institution, going from senior all the way to equity, actually. That's kind of the capital structure. But what you can do is you can invest in not the senior debt, but just one below and actually get more yield. But it's the same issuer. So it's the same company. If you think the company or the institution is going to be okay, it's another way you can extract that. And then finally, it's actually having a good balance between developed markets and emerging markets. That's another way you can do it. A lot of options out there do offer similar outcomes, but actually when you look underneath the bonnet, being able to have a global opportunity set allows you to go and deliver that. So that's probably the enhanced yield part, but how do we keep the price stability or the liquidity? That's something else where to be credible, you need to have, that security for clients. So for us, having that A- credit rating means, high quality portfolio, keeping the duration or the interest rate sensitivity, you mentioned, Reggie, keeping that between 1 and 2 years. We actually think the sweet spot's around about there. You could go maybe a little bit more, but this fund sits very much at that short end. And again, capping your downside risk, as Natalie pointed out, we've got a few targets there that allow us to really keep this fund, in that kind of price stability part. And just to let you know, since launch, the fund hasn't had a negative month. And actually, if you compare it to similar markets that invest in, those have had negative months since launch.
So the fund actually pays a money income. And if you look at the latest annualized distribution yield, is at a very attractive, from my perspective, level of about 4.8%. So it has that recurring money income stream.
Okay, 4.8% is the year based on the past year's record, right?
Based on the latest payout.
Annualized. Okay.
So from the risk perspective, right, I was thinking like, how is the back testing, right, like as compared to other, so that you can come up with the list of like mitigants, right, that can make sure that they perform at the rate that you want. And then at the same time, the risk won't tilt over to the riskier.
All the funds are pretty much that we launch go through some sort of back testing, stress testing. We have some very clever people in the background who can do a lot of modelling of previous market events, and you can contest your current model against that. And before launch, we actually did this, and we used 2022. Is a great period to kind of really test the portfolio because that was the most negative year in recent times for bond markets. So having, a max cap on high yield, as we said, having, maybe some specific country limits as well also helps to keep risk contained.
Because I think the last 3 years has been like unprecedented, high inflation, high interest rate. I mean, so like going forward, what do you foresee? Like how will this fund behave in like a high interest rate environment and a higher than normal interest rate environment or low interest rate environment?
The fact that what this fund is trying to do is outperform cash. So whatever the level of interest rate is, it's going to try to achieve that, above cash return. And those three levers I talked about earlier, that's really how we're looking to deliver that. And as I talked about earlier, about outcome orientated, right? Outcome orientated is, it doesn't really matter what the level of interest rate is. It's really about what's this fund trying to do. And if as long as it's achieving that enhanced yield above cash, really that's what people need if they're in cash and they want to come out. But to your point, I guess maybe a little bit of, in this market, there's a little bit of an opportunity to say, because the Federal Reserve hasn't cut rates as aggressively as other markets, but there is obviously a lot of focus on the Federal Reserve coming up, and it's expected that there will be rate cuts to come. That is obviously positive for bond markets, and for a fund that invests at the very short end of the market, it can definitely benefit from those rate cuts from a price appreciation perspective. But again, having that global opportunity set, having all those levers, that's what really this fund's going to use to achieve that above cash. So yeah, in a nutshell, doesn't matter if interest rates are high or low, this fund's going to try to outperform cash.
That's where, we really have to manage investors' expectations. So when rates fall, our yield will come off as well. So it's still a better home for your cash than, say, putting it in deposit and other type of investment options.
And remember, you're going to lock it away as well. If you put it in an FD, if you put it in any bond, single bond.
Or endowment plan.
You're giving up liquidity because you're leaving it and it's being locked away. And that then gives you the less flexibility. Whereas this fund, there's no lockup.
Nowadays, because of the instability of the Federal Reserve due to Trump since April, right? So I think there are a lot of investors that actually move money out from US market. So what is your view on that move? And then what is your perceived going forward, what will happen to USD as a reserve currency, all this?
Just to add, right, because I think we're knee-deep in this space, right? So I've met everyone in the space, right? So everyone tell me, business is very good because US dollar got downgraded, so money has to go somewhere, right? So there's a lot of inflows into the Singapore markets, right? So it is what it is, right? But because some structure within the portfolio, non-US dollar denominated assets, you will kind of hedge it to the US dollar. Of course, there are nitty-gritties in the middle, right? But that's part of your idea, right? So to me or to us, when we were talking about it, then it became maybe we should try to understand what's the house view, right? On the US dollar, what's the plan around here? Because you're gonna cost it through hedging, right? So I want to know where you guys looking at this.
Take one step back and think about, to your point, the US has been challenged in terms of the monetary policy backdrop. I mean, we all know Donald Trump has pretty much been trying to nudge Jerome Powell out the seat for some time. He's obviously been very vocal on his opinion of the current Federal Reserve chairman. But actually, what did Jerome Powell say at the Jackson Hole Symposium? So this is like a summit that is really key for investors to hear the views. Essentially, Jerome Powell flagged ahead. He said inflation risks are now diminishing. So he's not worried about persistently high inflation in the US. But what he is worried about is the employment backdrop, because unemployment is rising, new job creation is down in the US. So that was obviously a risk. And the other point was that this, let's say, increase in prices because of tariffs, and we all know this has been the buzzword, God's sake, since, like you say, since April, tariff, that has been, that impact of prices should only be a one-off. It shouldn't be like a permanent influence on persistently high inflation. So what does that all mean? Well, Jerome Powell effectively said that current policy settings are too restrictive. So that's the biggest signal to say, right, the US is looking to cut. So what's the market's view now? There's probably a 90% probability that there'll be a 0.25% cut at the next meeting. However, as data deteriorates, that could, or if it should deteriorate further, that could lead the Federal Reserve to be more aggressive over time. Our view is probably 2 cuts for the rest of the year. And I think, what does that mean for the dollar? We also think the dollar is still, on a broad basis, still pretty expensive. So that probably means the dollar needs to come down. And going back to your point, what does it mean for hedging costs? What does it mean for Singaporean investors and, in funds? Actually, as the interest rates come down in the US, that narrows the differential between Singapore interest rates and yields and the US, and that basically means lower hedging costs. So ultimately, clients can benefit from a lower hedging cost going forward, because I don't think Singapore yields, hopefully, I mean, I don't know, I don't think they'll go any lower, but I'm hoping the differential will narrow, and that should be beneficial for Singaporean clients.
I think we've gone through quite some details on the fund, right? Which I think it's important. Kind of help the retail investor kind of frame our minds a bit, right? Because I think we're very used to these days where funds are tied to investment mandates, right? So, okay, there's a structure and the fund manager is tying everything to this structure. You can't change the structure because that's what we all commit to, right? That's the mandate. But because this is like an outcome-focused fund, and when we were talking about it, it does sound like the fund manager, which is you guys, maybe not you specifically, but Aberdeen has the space to kind of maneuver around in terms of okay, what do we sell? What do we buy? How do we change our positions to meet that outcome. So like, how do I understand, how do I kind of find confidence and comfort that, okay, this is kind of what it is, right? So that we all abide by our understanding.
The first thing is at Aberdeen, we have a huge investment platform, a research platform. So it's not just maybe two people trying to come up with like all the ideas. So what you can take confidence in is that Aberdeen has a huge research platform in fixed income. Broadly they do, but just in fixed income, we have over 130 professionals who are looking at markets, who are contributing ideas. So the two lead portfolio managers of this fund actually benefit from all these best ideas. And it also allows them, because everything's standardized in terms of research, in terms of how we look at ideas, they can compare ideas very easily. The best example would be, I think, Temasek's a good example of a bond, equivalent bond, that is trading at a premium to US Treasuries, but has a higher rating. So, Temasek is higher rated than the US government, but trades with a slight premium. So these are ways you can evaluate different opportunities. And so to take confidence in that, we do the research, it's very much bottom up. We can move between emerging markets, developed markets, use a little bit of high yield if need be. We can also look to, as the curve starts to normalize, as they say, you talked about earlier, going further out the maturity to get more yield. As that starts to come back, the fund does have scope to do that as well. So it's not necessarily restricted as you think, and maybe the guidelines are keeping it very restricted. It's actually quite a flexible fund.
Don't get the wrong idea that it's fully unconstrained. If it's totally unconstrained, flexibility is good, but when it's full flexibility, they get a bit uneasy. Like, what if one day you decide to go 100% high yield? Yes, at the end of the day, I think it's very important that, we still set limits, we have guardrails, and that's to Amit's point earlier where we set like high yield maximum 20%, and even like things like China exposure, we also have a limit. We have to manage risk prudently.
Yeah.
I think that's, those kind of ranges, limits that we will have.
I understand, right? So the construct is that, okay, you want to get more yields, you will look for deeper down the curve, further down the duration, right? And I think you've kind of shared your ideas, right? And a common theme in this fund is emerging markets, right? And what has a Scottish company got to do with emerging markets? So most people, when people think of emerging markets, it's like ASEAN, maybe Africa, maybe LATAM, So like you guys, so just tell me like what is the kind of competitive advantage? Because my understanding or my belief is that as more and more people invest in this part of the world, then there's increased competition in finding the good deals, right? So when nobody cares about it, it's all there. But when people care more and more about it, when more and more money is flowing in, then it becomes a competition for the good deals, right? So I just want to understand your capabilities as I try to build the trust with you guys, right? So I need to know, like, what do you know? What can you do, in the emerging markets? Just share with us.
Aberdeen have been in Asia, just even if you think about Asia, for over 3 decades. So actually having that footprint is very important. Because you get the on-the-ground feedback. You get, when we're sending our fund managers, our analysts to all these different countries, like you say, in like Africa or LATAM or even in Asia and parts of the world, what they're getting is really sort of that unearthing those opportunities, because they're hearing from the policymakers. They're hearing exactly what's going on. They're seeing if buildings are being built. They're seeing what's going on in those economies. And I think that's really important, because you're exactly right. I mean, how can you be or give credibility when you've probably never visited the country that you're trying to invest in? So Aberdeen have got a heritage of being in these markets and having boots on the ground in the markets. And I think that's really important to, showing you're credible. And emerging markets is one of our strong points. As well in terms of AUM and what we have.
And not just on the ground boots, right? I mean, like company visits. I've been hearing the PMs every year very diligently. They'll visit that country a few times a year.
But no, I think as well, fixed income is just one part of evaluating an emerging market or a country, actually, or any investment opportunity. But what Aberdeen has, because we invest across other asset classes like equities, actually it's very powerful when you bring equities and fixed income together, because you've got one set of investors or portfolio managers evaluating a company from one angle, and then you've got another angle. And actually that is super powerful, because you can then get almost a 360-degree view of a company and really understanding what's driving it. Is it shareholder friendly? Is it fixed income friendly or bond friendly. So that is something I think Aberdeen also has to its advantage, because it has a very strong heritage in emerging markets, both on the equities and the fixed income front.
So then, like, what is the kind of consumer experience, to onboard, and what is the, essentially, because you said that there's like a monthly payout. So I think for our audience to really understand the product from a construct standpoint, to the user, how does that look like?
I guess we can look at it both globally and in Asia, right? So this product is something that we're actively promoting, not just in Asia, but in other parts of, in Europe, in UK, etc. And it has garnered very strong traction. If you look at the fund size, it speaks for itself. We launched the fund about 2 years ago, and right now it's already inching towards $500 million Sing dollar. So the demand is really there. And some of the feedback that I get from talking to investors locally is that, there are existing solutions out there, but how do we differentiate ourselves? So things that they actually took note of is our diversification. Opportunities is everywhere. So we invest in US, Europe, Asia, not just purely in Singapore or Asia. And we have those multiple yield enhancement levers to really boost the yield. So, when you compare our yields with others, we tend to be on the higher side as well. Yeah, and also the monthly income. I think that's something that has received really, really good feedback.
So I have to purchase this from a licensed financial advisor, or like my bank, essentially. That's kind of the process, right?
Yes.
Okay. So I don't deal with the fund house directly. I have to deal with
digital
or
DIY,
a platform.
like an ETF, right? Like it's not a fund. So like it's not a traded fund. So essentially, this is all like secondary market type of situation, right? Okay.
In regards to like building out our portfolios, I think the traditional is 60-40, 60% equity, 40% fixed income. I was just wondering, like, how would SDEI fit into the fixed income allocation of 40%? Yeah, just want your view on it. Like, who are the profile of people who are looking at?
The key thing here is in a 60-40 portfolio, it's going to be in that fixed income bucket. I guess when you look at the fixed income bucket, you need to kind of, assess what is the low yielding parts of that bucket. If you've got cash and money market in there, that's the first obvious route for me to say, well, as someone who is investing in 60-40, you've got maybe 10% in cash. Actually, this is probably going to make your cash work harder. So that's probably one area. Clients or portfolio constructors can use it in a 60-40 construct. Similarly, if they're maybe got a bit of risk in the portfolio, obviously they have 60% equity, but maybe they've got some high yield risk in the fixed income bucket, and maybe essentially they think the portfolio's just a bit too risky, then they can look to either take from one of those and use SDI as a position where you're not going to give up too much yield. You're going to give up yield, yes, but you're going to enhance the price stability and liquidity of the portfolio. So those are kind of ways you can look at it from a standpoint, helping to increase yield, but also then helping to increase price stability and downside protection.
I mean, talking to some advisors, right? I mean, not too different from what Amit has described, but some of them even go to the extreme that within that fixed income bucket, they only invest in short duration bond because they have a lot more other risky investments going on, and they just want to have this as more of an anchor within the portfolio. And not just that, I think increasingly they're looking at it as a liquidity too, because you can actually get back your money fairly quickly.
What is fairly quickly? Just so we understand.
1 to 3 days from our fund perspective, depending on currency. Yeah. And you can get it without drastic price movement. So if you're just waiting to deploy your money into other areas, and in the meantime, why not put it in something like SDEI and get you better yield?
One more question about liquidation, right? So you were saying like, it's a marginal difference, right? A little bit of difference. So I do want to understand like what accounts for the difference as a retail investor, because when I go in, I want to make sure I mean, we're in fixed income. I want capital to come out in totality, right? So like, help me understand like what is the variance, or what causes the variance? Yeah.
The variance in bond prices, we've kind of talked about it today. There's credit risk and there's duration risk, so interest rates. And because we're keeping those contained, quite well by having a high, let's say, barrier in terms of credit quality and keeping the risk low by maintaining interest rate risk in a duration of 1 to 2 years. So those help with price stability, absolutely. And what that means is the variability. So when you kind of plot this fund against, say, US cash or money market proxy, it doesn't have a completely, straight line like cash does, but the profile is really, really stable. And for me, that is the key thing for this fund to be able to do that. And what's one of the drivers? A substantial portion of the fund actually is in bonds that have less than a year to mature. And what that gives you is what they call a strong pull to par, or a strong pull to the maturity of that bond, because there's not a lot of time left. So you actually get that really strong stability. I think we had, a drawdown this year, to your point about April being quite a volatile period. We had a drawdown of about 0.8%, roughly, 0.8%. And that was recovered within couple of weeks, and then by the end of the month the fund was up by maybe 0.3 or 0.4%. So what it showed you was those really strong pull to par characters, really strong price stability, and that's really what you need. And that's where, yes, it's not cash and it will never be cash, but it will try to exhibit as best as it can those price stability qualities that you would associate, and liquidity as well. So having, enough in cash and government bonds as well.
You've backtested this, right? From a max variance standpoint, what are we expecting?
We don't expect inflation to be globally high and persistent like it was back in prior to 2022. So yeah, 3% is probably, that's what we've modeled as a target level. But the volatility as well has only been 1%. Volatility since launch, so that we have a target of around about sort of 1 to 2% as well.
I think I understand what they're trying to do, right, and trying to model that additional yield on top of the cash, but trying to manage this whole part about volatility and all that, which is why there's a whole okay, if you have cash and you want to make more, you can do a step up, or if you're too risky, you do a step down, right? So that's kind of the goal.
That's how I kind of structure my clients' portfolio. So it's actually even within the fixed income and the cash component, there's multi-layer thing. So SDEI actually can fit into depending on the client's needs. If they want higher yield, they like the usual Singapore saving bond or the previous SSB rates. But then to find something that's stable and lock it in at 3% nowadays is impossible. So I do see SDEI have a place in the current market because all the yields are going down. I think, Natalie, you talk to a lot of advisor and then the probably clients. And then what is the most the profile that we actually go for this SDEI? Someone just started out working, could it be part of the emergency cash? And then someone who is middle age or buying a house, just now you stated the house buying process. And then also someone who is retiring, probably you can give us some perspective on how that kind of fit into them.
For every advisor out there who does proper, portfolio management, you always have that fixed income category, and then to your point, right, you always have allocation to different level of risk. So that will always play a part. Is the allocation to the defensive, low volatility part of the portfolio. And even if let's say you are, I do invest in bonds, too boring, right? I want to go for equity, high return. But as I said earlier, while you are still deciding, okay, am I going to invest into which market am I going into? In the meantime, you can still park your cash in SDEI. So they're just many use cases
absolutely
that I have come across.
I think that was a good discussion, right? Helps us understand a little bit on the structure, the risk profile, what we're looking at, what are you tuning in for, right? So yeah, any last things you want to say to our audience?
I guess for me, I just want to reiterate the strength of fixed income capabilities within Aberdeen. A lot of investors out there, they're actually very familiar with us through our experience in investing in Asia, emerging market equity. Not many of them actually will know that, hey, you're actually very good in managing credit strategy. So over the years, we have brought in several very good solutions, and we actually look to bring more to our investors in Singapore. So do stay tuned for what's to come from Aberdeen.
Finally, just to recap, SDEI, it's that step out of cash. It's a credible step out of cash option. It gives you that enhanced yield, gives you the price stability, and also gives you that liquidity, both from a portfolio and a settlement perspective. And I think, there's a lot of options out there, but for clients, maybe that's the challenge. There's too many things to think about. There's too many challenges. What's going on here? What's going on? But I do think SDEI can really, as Natalie pointed out, and as you've mentioned as well, that it can really fit into that outcome that clients are looking for, various outcomes that clients are looking for.
So with that, thank you for your time. We hope you enjoyed today's episode on Chills with TFC. If you have any specific question to the Aberdeen SDEI Fund, you can click on the link below and then, go and find out from your licensed advisor, right? Very important. So with that, that's all for today's episode. Thank you all for your time. And if you enjoyed today's episode and you want to stay updated on what TFC has to do, go to thefinancialcoconut.com, put your email address so we can route out the algorithm to get connected with you all the time. And that's all for today. We'll see you at next week's episode of Chills with TFC. Bye-bye.
Bye.